Welcome back. Fannie Mae just announced their latest real estate market predictions through 2025. They're predicting we're going to see an increase in home sales through 2025, yet mortgage rates or average rates are going to be at or above 6% for the next 2 years. Here's a new report just posted on the 23rd of April. It says a hot economy and inflation likely to keep rates higher for longer. We've been talking about this for quite some time. And by the way, I'll have an update for you guys regarding the Street's forecast for future rate cuts by the Fed this year. It says the rise in new home listings projected to boost home sales despite the recent run-up in rates. So they're saying here that we're seeing more houses being listed for sale. That's going to increase inventory levels as well, but also help increase sales as well. It says stronger than expected economic and inflation data have pushed interest rates higher and financial markets to price in fewer Federal Reserve rate cuts this year. I'll have some news to share regarding that because, remember just a few months ago, everyone was talking about how the Fed was going to pivot or start decreasing rates in March. And here we are in the end of April, no rate cuts in the near future. It says, while the ESR group, which is their economic and strategic research group by Fannie Mae, is forecasting existing home sales to rise modestly over the course of the year, it expects the flow of new listings, the amount of people listing a house for sale, to outpace home sales, which should help gradually thaw or help improve housing inventory and contribute to decelerating home price growth. So that was a lot, right? Again, think of inventory levels as a bathtub. The amount of new listings hitting the market is water going to the bathtub, which of course increases the water level or increases housing inventory, whereas the drain of a bathtub is pending home sales and closed home sales. So we're saying here that the flow of new listings or water into the bathtub is going to outpace home sales or the draining of the bathtub. So in other words, supply is going to outpace home sales this year. And when we see more new listings compared to home sales, that increases the water level or increases housing inventory, which again puts downward pressure on home prices. Now, speaking of that, here is a new report from Realtor.com. Actually, we just announced last Thursday. So in regards to new listings, that increased by 7.2% from 12 months ago. Meanwhile, active listings or inventory rose by 29.1%. So we're seeing a rise of new listings, and that's causing active listings to increase further. In regards to the odds of a future rate cut by the Fed, a great tool I use is the CME Fed Watch tool. Just Google that. I'll take you to this right here. And of course, I'll provide links in my video description below for all the articles I'm going over in today's video. So in any case, I'm looking at their next meeting, which is 1 week already. I don't think anyone's predicting that the Fed's going to cut rates in the next meeting. So for example, by 95.9% chance, we're going to keep rates the same at 5.50%. That's the federal funds rate, which is the rate that banks charge each other for overnight lending due to reserve requirements. The Fed does not control mortgage rates, but the fluctuations or the increases or decreases in the federal funds rate does have an indirect relationship to mortgage rates. And so because we're not seeing a Fed pivot or a cut to interest rates anytime soon, that's why we're in this higher for longer interest rate environment. So their next meeting after that is on June 12th. A high probability we're going to be at the same rates. July 31st, again, a high probability we're going to be at the same rates again, a pause. Then in mid-September, a potential for a 25 basis point rate decrease. At least a 46% chance we're going to be at 5.25% compared to 5.5% right now. Now, this is much different compared to just 1 month ago because of this. The odds of a 25 basis point rate decrease, again, right now, which is on April 23rd, a 46.4% chance they're going to decrease rates by 25 basis points. But 1 month ago, we're at 19.6% and a 44.6% chance we're going to be at 5% or a 50 basis point rate decrease. On top of that, 1 month ago, there was a 29.9% chance we're going to be at 4.75%. That'd be 3 quarter point rate decreases, but the odds right now of that is only at 3%. So again, higher for longer is the name of the game here. Let's fast forward actually to December. So to end the year, the street's forecast is at, for a 35% chance, we're going to be at 5%. So 2 quarter point rate decreases this year is what the street is forecasting, which is much different compared to 1 month ago. So 1 month ago, the odds of that was 18%, but the street was kind of split between a 1 percentage point decrease down to 4.5 and a 75 basis point rate decrease. So just 1 month ago, the street was forecasting for a lot more rate cuts, and now we're only looking at around 2 rate cuts this year. And because of that, Fannie Mae believes we're going to have this higher for longer interest rate environment. So we're going to see home sales increase, but these higher rates are causing housing affordability issues for many home buyers right now. Going back to Fannie Mae's report, stronger than expected economic data, including labor and consumer spending reports, retail spending just announced last week, I believe it was, came in much higher than expected. And on top of that, we had a much higher reading on CPI or the Consumer Price Index, the prices that everyday consumers pay for goods and services. This has led financial markets to increasingly push back expectations for the Fed to cut rates this year, as we saw. Fannie Mae also believes the interest rate environment looks increasingly to be one of higher for longer. Thus, we have revised our federal funds rate outlook to just 2 rate cuts this year from 3 starting in September this year. Previously, it was actually in June. Home sales are also expected to remain subdued, but drift higher over 2024, which, by the way, I'll share their forecast for home sales, new home sales, and existing home sales through 2025 and compare that going back to 1989. So even though they're calling for sales to drift slightly higher from 2023, we're still going to be at very low levels. Okay, let's talk about that here in just a little bit. Let's first discuss, though, housing starts. What I'm more focused on are single-family housing starts. This is the beginning phase of the construction of a brand new house. That decreased by 6% in 2023 compared to 2022. But this year, they're calling for an 11.3% increase and then a 4.6% gain in 2025 from 2024. This is much different compared to multifamily. Look at this. Multifamily this year down 20%, and in 2025 decreasing further down by 2.2%. I would imagine this forecast here is because we have very close to all-time record highs for multifamily units under construction right now. Let's also discuss new single-family home sales as well as existing as well. So new single-family houses increased by 3.9% last year compared to 2022 versus existing tanked by nearly 19%. So new home construction sales rose slightly, but existing absolutely tanked at 4,090,000. That was the lowest level since 1995. Let's fast forward to this year, though. It's actually pretty much on par with new versus existing, rising by about 4% in 2024. Then 2025, increasing by 12.8% for new single-family houses, and then a 10% gain of existing houses. Also, leave me a comment below with your thoughts regarding this, because I noticed this as well, is that in Q2, by the way, all these figures right here are Q1, Q2, 3, and 4. And it's interesting to see here that sales of existing houses, they're calling for Q2 to decrease compared to Q1, but thereafter a small gain each and every quarter. Compare that to sales of new houses increasing each and every quarter through 2025. Okay, let's talk about how these figures for existing houses compare to years past. And I actually put this together. This is based on annual figures from the National Association of Realtors going back to 1989. So let me just kind of take a step back here, talk about what happened in 2021. Back then, we had 6.12 million existing home sales that year. That was a 15-year high. 2 years later, back in 2023, it decreased to 4,090,000. That was the fewest number of existing home sales since 1995. So in two years, we went from a 15-year high in sales down to a 28-year low. Also, by the way, last year at 4.1 million around, that was around 1 million less than historical averages going back to 1989 as well. So in any case, let's talk about their forecasts this year and next year. So again, this year, 4,266,000. Besides last year, that would be the fewest number of existing home sales since 2011. In other words, extremely low levels. Then in 2025, to increase to just under $4.7 million, that would be a 3-year high, but around 300,000 fewer compared to the long-term average. By my dumb math or my nerdy Excel formula there, the median number of existing home sales since 1989 is just over 5 million. So therefore, their forecast this year and next year quite a bit lower than the long run average. Also, just for fun, I added the year-over-year change, and also I added this as well, the change from 2019 and 2018, which is obviously pre-COVID. If we had 4,266,000 this year, that'd be a 20% decrease compared to pre-COVID levels. And then in 2025, a decrease of 12%. Going back to Fannie Mae's predictions, let's talk about home prices, then rates. So in 2024, they're calling for home prices based on Fannie Mae's HPI, or their home price index, to increase by 4.8% from 2023, then to increase further to 1.5% compared to 2024. Also, something I noticed as well, I've been making this video for you guys for a couple of years now. When looking at their forecast that was published 1 month ago, this is a significant increase as well. So in their forecast from 1 month ago, they called for a 3.2% increase in home prices in 2024. Now it's at 4.8%. Also, a month ago, they called for only a 0.3% increase in their HPI in 2025. Now it's at 1.5%. Remember when I started the video saying how we're going to see this decelerating of home prices? Here's exactly what I mean by that, because they're calling for home prices to increase through Q4 2025, but the rate to slow down each and every quarter. So for example, in Q4 2025, their HPI is going to increase potentially by 1.5% compared to Q4 2024. All right, let's also talk about their forecast for average 30-year fixed rate mortgage rates. In Q2 this year, they're calling for the average rate to be at 6.7%, exactly the same compared to Q1. So rates been more or less flat for the first half this year. Thereafter, though, they're calling for rates to decrease, but not by very much. So for example, in 2024, they're calling for the average rate for the entire year, on average, to be at 6.6%, then to decrease to 6.1% in 2025. And again, the reason why they're calling for this higher for longer interest rate environment is that because of higher for longer inflation data. In other words, inflation's not wanting down just yet. And on top of that, we're not seeing a whole lot of cracks in our labor market thus far as well. So because of all this, they're calling for only 2 rate cuts by the Fed this year, which is going to keep average mortgage rates higher for longer as well. But of course, I would love to hear from you guys. What do you guys think about their real estate market predictions through 2025? Please leave me a comment below. Thank you so much for watching today's video. I appreciate you. Have an awesome day, and we'll see you in the next video.